Financial management for small business. Well, uh, the small business have also made great success in the modern days, and their success or failure matters a lot for the national income as well, for the national business as well, and they are often closely related to adequate or inadequate funding. For example, one study of nearly 3,000 new companies revealed a survival rate of 84% for new businesses with initial investments of at least $50,000. Unfortunately, those with less funding have a much lower survival rate. Why are so many startups underfunded? For one thing, entrepreneurs often underestimate the value of establishing bank credit as a source of funds or use trade credit ineffectively. In addition, they often fail to consider venture capital as a source of funding, and they are notorious for not planning cash flow needs properly. Establishing a bank and trade credit. We're only talking about the small business right now, in fact. Well, some banks have liberal credit policies, offer financial analysis, cash flows planning, and suggestion based on experiences with other local firms. Some provide loans to the small firms, and they provide loans to the small businesses in bad times and work to keep them going. Some, of course, do not obtain the credit, therefore, begin with finding a bank that can and will support a small firm's financial needs. Once a line of credit has been obtained, the small business can seek more liberal credit policies from other businesses. Sometimes, for instance, suppliers give customers long credits per odd, say uh, 45 or 60 days rather than 30 days. Liberal trade credits terms with suppliers let firms increase short term funds and avoid additional borrowing from bank. Long term funding. Naturally, obtaining long term loan is more difficult for new businesses than for established companies. With unproven payment and ability, startup firms can expect to pay higher interest rates than older firms. If new enterprise displays evidence of sound financial planning, however, the Small Business Administration (SBA) may support a guaranteed loans. The business plan as a tool for credit. The startup firms without proven financial success usually must present a business plan to demonstrate that the firm has good credit risk. The business plan is a document that tells potential lenders the money needed, the amount, how the money will be used to improve company, and when it will be paid back. California entrepreneur Jonathan Rodriguez, for example, had no business plan for his cellular phone store, and the business grew too fast to control. The store brought $250,000 in its last year, but debt had piled up high. He, uh, he was afraid of bankruptcy. Rodriguez later managed to pay off all the creditors and closed door, then watched his 12 employees start their own business, and succeeding was a slap on the top of a slap in the face of the CEO. I tried it my way, but it didn't work. It was an expensive lesson, said Rodriguez. While Rodriguez had a talent for sales, didn't have an understanding for facets of businesses, other facets of the business, especially finance. And one of his friends insisted that he should attend a workshop on business planning before starting Hope for New Company. He soon found how much he didn't know about the business. I didn't realize how much it meant to have a business plan, he said. It was the way I should have done it in the first place. Having learned from the experience, he opened a new business in closed circuit surveillance for residents, business customers. This time, however, he had a business plan to take Neighborhood Bank and got initial funding for the startup.